Hi, this is Lindsay Lockman at Summer in the City, the second annual CSR Investing Summit. I'm here with Indrani Day, Director at asset management firm New Amsterdam Partners. Hi, Indrani.
Hi, Lindsay.
Well, thank you for being here.
My pleasure. Thank you for inviting me.
So, you've recently concluded a major study on the impact of ESG investing. What were your core findings?
The very core finding, and I thank Thomson Reuters for giving me the data, because this kind of data, it's very, very useful. Essentially, in a nutshell, if I had to say 3 points, it would be something along the lines of, I find that the ESG ratings have a lot of information about a company, particularly in terms of its volatility, what kind of risk that stock has. So companies that go higher on the ESG rating tend to be much lower in their risk. And what is very interesting is this negative correlation between ESG and a company's risk becomes stronger when markets are more volatile. So there's tremendous implication for portfolio management that, how do you manage volatility in your portfolio? ESG rating is a very, very useful thing to see. And it's kind of interesting. Initial research on the ESG was more on the alpha front, directly on the return. And obviously in the last couple of years, we have more focus on the risk, more focus on the risk adjusted return. Risk is just becoming a very, very important thing. And it's so interesting that because ESG has a negative correlation with risk, it has a positive correlation with risk adjusted return. So it's a very useful data point. And the other thing we did was recently there was a paper by Kritzman which essentially says that if you exclude companies on the basis of ESG, you're taking away from, performance and things like that. So having laid that there is a reason to think of low ESG companies as a tail risk, we say, all right, what happens if we truncate your entire universe on the basis of just taking away the lowest 5% or the lowest 10% ESG rated companies? And these are peer rated, best in class. So I'm not talking about excluding entire sectors. I'm just saying the worst ESG rated companies. And then we do a random portfolio selection from the entire universe, randomly pick up 100 portfolios and see what their returns are. Exclude the bottom 5%, bottom 10% from the universe, and from that restricted universe, again do the same kind of random sampling and create 100 portfolios. So you get two return distribution, one from the unrestricted and one from the restricted sample by excluding the lower ESG. And what is very interesting, you get a better return distribution from the restricted universe, meaning if you really delete the lowest ESG companies as a tail risk, you will have a better distribution to work with. And then obviously as an active manager, you're going to actively use that information. You're not going to be randomly deleting and things like that. So this is a very, very useful point in stock selection, in portfolio construction.
That is very interesting. And have you found any explicit examples of how ESG compliance mitigates risk?
Yes, of course. Let me just quickly break down the E and the S and the G. Of course, environment, people understand, if you're polluting, you have a negative, there are all kinds of compliance issues there. The governance is very easy to understand that a company that's well governed should be doing better in terms of shareholder returns. They'll be more considerate of the right things to do. And social, which people tend to think of as being very nebulous, it's not nebulous at all. The kind of things that come under these social metrics, it's your supply chain management, your product risk, your compliance with Dodd-Frank. So these are very, very important data points that really affect the company's core function, operation, and has direct impact on its return on equity, its actual operating metrics, and hence on the shareholder returns.
And overall, what do you see as the major trends in socially responsible investing?
In a nutshell, I think over the last 15 odd years, it went from a question or a perspective of ESG being an exclusion based, where either because of values or faith, you are deleting entire sectors or subsectors. It's moved on from there to be something that the moment you are excluding an entire sector, that's obviously a very different perspective from saying, I'm not excluding anything, I'm just saying each company compared to its peers, which of them have the best ESG practices, because I strongly believe they have an investment perspective. It's going to impact my investment returns, which is why I think ESG is becoming, it's no longer a very unique thing. It's becoming more and more mainstream simply because everybody is understanding this is a very, very important thing. And similarly, as it's becoming mainstream, it's also going across the asset classes. I mean, it started off mainly in the equity stream. Now we see it in the fixed income. As a lot of the speakers have been saying, you see interest in the private equity. It's something that's becoming core to the investment process across markets, across asset classes.
Well, thank you so much, Indrani, for being here today. And Indrani's paper, along with this interview, will be available on Thomson Reuters Corporate Responsibility Indices website, which is www.trcri.com.
Thank you.
Thank you.